I'm Bill McWilliam, President of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of InkResearch.ca, Canada's first online financial news and research service, providing insider news and knowledge to investors. Welcome back to the show, and happy Canada Day.
Well, happy Canada Day, Jim, to you and all your listeners.
The International Bank of Settlements encouraged central banks to continue raising interest rates even if inflation stays low. Is Canada on side with this?
It appears to be playing out that way. We have had Stephen Poloz, Governor of the Bank of Canada, out this week basically saying low rates have done their thing and the economy is moving back into action. Now, of course, we've talked about this for some time on the show. Over 6 months ago, we were saying how we saw through our insider index rebalancing that insiders were pointing to a stronger Canadian economy, yet the mainstream media, all they were talking about was how bad things were in Canada. Well, we saw from what insiders were doing with their money and how our Canadian Insider Index was shifting into Canadian retail and economy-sensitive stocks, that the economy in Canada was picking up and positioned for a move up, and lo and behold, that's what's happened. What the big news is, though, Jim, is that the Bank of Canada is not using low inflation as an excuse to sit on its hands and do nothing. That's the big news, and that is really, really a sea change. And there's probably a couple of things that explain it. I don't think all of a sudden Stephen Poloz just decided that now's a good time to raise interest rates. I think you're seeing a global move by central bankers to try and lift rates out of the doldrums since the financial crisis, and Canada does not want to be left out of that parade. And secondly, we have NAFTA negotiations going on with the Americans, and I don't think having Canada trying to devalue its currency by keeping rates low when it's got the best, economic growth in the G7, I don't think that was going to go over too well at the negotiating table. So, I just don't think the Bank of Canada has a lot of choice here. My personal view is that Stephen Poloz would love to have the dollar lower. All he's been focused on since his Harper appointment was to juice the housing market and exporters, but I think other events are taking over and forcing his hand. So I think there's a very good chance we're going to see rates rise in July, and I don't think it's a coincidence, Jim, that NAFTA renegotiations are also supposed to start this summer.
Is that also a government solution to the real estate bubble?
Well, look, this has big implications for a wide range of assets. In the U.S., since the great financial crisis, with this experimental monetary policy of keeping rates low and, in the U.S. QE, quantitative easing, the stock market's benefited, commercial real estate has benefited, not so much the housing market, although it's starting to heat up now. In Canada, it's all gone into housing. The stock market's, it's gone up, but not to the same kind of hyperinflationary levels that you've seen real estate move in Vancouver and Canada. And in Toronto. And there's a lot of explanations for why, for example, Vancouver real estate moved up, and it's not all because of the Bank of Canada keeping rates astronomically low, but that's a good explanation for a lot of the activity we're seeing in housing. Because yes, we've seen money come in from China to spark buying, but that in itself does not explain why real estate prices are going up in the Fraser Valley at the same time. So you've got a lot of factors, and the Bank of Canada has been a big driver of real estate hyperinflation. The fact that they're now moving rates up in conjunction with other central banks this is going to hit asset prices like real estate. The question is how much, and a lot will depend on how far these central banks go in raising rates. You know, if the Bank of Canada does one rate increase, it's really not going to make any difference. I mean, it will make some difference, but you know, don't expect that to take the steam out of the housing market. But if they go on a parade, you know, lifting it up to say we're here in 2 years with the rates up, 2 or 3% from where we are now, it's going to have a big impact. You know, so it's not just real estate. It's going to have impact on speculative growth stocks and pricey growth stocks. So whether you're talking marijuana stocks, which have peaked, it seems, and you know they've made a bit of a comeback. Interestingly enough, as long interest rates have pulled back here, but they're going to have headwinds if these central banks keep raising rates. And FANG stocks, you know, the Facebooks of the world and Facebook, Amazon, Apple, Netflix, Google, right? The FANGs. They're gonna have problems because of their high valuations. It's all based off of using low rates to discount future cash flows, right? So it means like you're willing to pay a higher price for growth way out in the future because rates are so low. Well, as rates move up, those stocks become less attractive. So it's not good for FANG stocks. Canadian bank stocks, this will be an interesting summer for them because interest rates going up. It's a mixed outlook for them in a rising rate environment. If the long bonds rates go up, then the bank stocks will do all right. But up till now, long bond yields have been hard pressed to move out of their trading range. So could have a mixed summer for bank stocks as well.
We'll have more with Ted Dixon right after the break.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
Welcome back. We're speaking with Ted Dixon. We've talked about marijuana stocks briefly right now. Is this just one of those things where there's so much buzz around them that people are scared not to invest in it?
Well, I think you're probably seeing more of that in Bitcoin and other cryptocurrencies now than the marijuana stocks. I think marijuana stocks fit into that category, but like many of these growth speculative asset groups, they have their kind of flavor du jour period, and I think marijuana stocks are probably going through transition now, and so separating some of the better names from the more Johnny-come-latelys or those with weaker managements. And that will be bought out by the stronger players. So, I think they're going through a change of early adopter investors, speculative investors, into those investors who are growth investors, but will want to, pay a reasonable price for these stocks and not chase them on the hopes and dreams that, they're just going to get higher and higher returns from being in these names. I think there's more of a sense of realism that's setting in right now, and higher interest rates are, it's funny how higher interest rates tend to coincide with a greater amount of realism that tends to show up in the market. So, higher interest rates lead to higher requirements for investors from companies in order to attract money into those companies. That's right.
I've noticed that I haven't seen any government budgets yet in Canada that take into account the kind of revenue they expect from marijuana. Have you seen any numbers?
I have not. Now, this will be the next, not necessarily the next, but this will be a big test for marijuana stocks once those numbers come out, because it'll indicate, how much of a royalty the taxpayer wants from all their businesses. But the government has to be careful. They can't overdo it, because if they overdo it, then people will go to the black market for their supply, and that's not going to achieve what the government wants either. So, I suspect they'll try and hit the ball down the fairway here on the taxation side, but it will have some implications for these stocks, but it's hard to tell right now how much is already priced in with respect to taxation. So look for some volatility in those names once the tax rates are known.
Now, some of the marijuana advocates have said it doesn't cost any more to grow a marijuana plant than it does a head of cabbage, and that's what they should be charging you, like $265 for a plant, let alone a few ounces of it or a few grams.
Well, that's one of the other risks for the industry is, how much margin compression will there be in the industry right now? Prices are significantly higher than that. So there's a lot of risk in these stocks that have not been fully, I think, appreciated by investors. Instead, they've been focused on the growth side, which has been fair enough, and you can do that when you have the Bank of Canada sitting basically at 0.5% interest rates, and the Fed, and the Fed at 0% and, buying assets. But the Fed's not doing that anymore. The Fed's raising rates and not buying assets. In fact, they're going to be selling assets. The ECB, what we saw a big move in the markets this week, because the ECB, hinted that the time is soon approaching where they're going to stop buying financial assets in the marketplace. So these are support systems that are being taken away from growth investors, and will give value investors more of an opportunity to find stocks that are attractively priced. So, we'll have to see. A lot will depend on how the bond market reacts. The bond market right now is still showing some skepticism, but yields are making another move up here in the last couple of days after Mario Draghi gave his speech. They've really moved on the fear, I think, that the ECB is going to stop buying bonds. If they stop buying, then you're left with only the Bank of Japan, and they're making noises about how the economy is improving. That's usually the first step in removing monetary stimulus. And as central banks remove monetary stimulus, Jim, investors are going to be confronted with the fact that there's some big players, central banks that don't have their back anymore, and that's a big change from 5 years ago or even a year ago, where you had at least the ECB and the Bank of Japan and to some extent the Bank of England buying assets, and of course you had banks like the Bank of Canada that believed that by driving down their currency and keeping interest rates low, we'd all become rich. Well, I shouldn't say that, but that some element of the Canadian society would become rich, and those elements tended to be price-taking exporters. That's all our central banks seem to really care about. But fortunately, they seem to be changing their focus now.
We'll have more with Ted Dixon right after this.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead zinc silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan district of northwestern BC. Check us out at blindcreekresources.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're chatting with Ted Dixon, Ted, if world growth hangs in there, then pockets of the Canadian market could benefit, including things like uranium and cobalt. I just saw an article today that said wherever you have found uranium, you can find rare earths.
Well, the premise here is that if global growth does not collapse anytime soon, and there's no indication that it is, it may be slowing down in pockets, there's still going to be demand for industrial and strategic elements in the, to keep the economy going and keep defense budgets in use. So things like cobalt and even uranium, which have some strategic importance, and there are other metals as well that will remain in demand. And interestingly enough, as you've had Western central banks talk about removing stimulus, last night there was a story out on Bloomberg that an quote unquote an advisor to the People's Bank of China was saying there'll be there likely won't be any more monetary tightening in China for the foreseeable future. Well, that foreseeable future means, up until the party congress in the fall probably. They don't want to really shake things up any more than they have as the Communist Party of China meets to determine the leadership in that party, for the next 5 years. So China is going to be a positive force on global growth. That should benefit elements of the Canadian market. Canada has been left behind in stock market rallies so far year to date. The Canadian Insider Index is up just over 1% year to date. It's ahead of the TSX Composite by almost 1%. But generally speaking, even the Canadian Insider Index is lagging other major markets and emerging markets. If China keeps its economy humming, that could help Canada regain some ground over the next few months, and that would include the materials space, and that would include sort of industrial metals and like perhaps lithium and cobalt. It's hard to see which ones in particular will benefit because you've got supply and demand considerations metal by metal. But certainly these stocks have been overlooked over the past year in favor of things like Facebook and the like that are been in favor because of low rates and a focus on supercharged growth companies. But back to basics will mean back to metals, and that should be good for the Canadian market.
Ted, always fun chatting with you. I hope you have a great Canada Day.
And same to you and your listeners, Jim.
My guest has been Ted Dixon, CEO and co-founder of inkresearch.ca, his website, CanadianInsider.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for our guests or for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.